What if I told you that at one point, the land under the Imperial Palace in Tokyo was said to be worth more than all the real estate in California? In the late 1980s, Japan wasn't just booming, it was unstoppable. Japanese corporations were buying Rockefeller Center. Tokyo's stock market was exploding. Real estate prices defied logic. Many believed Japan would overtake the United States as the world's largest economy. And then, it collapsed. But here's the deeper story. The real tragedy of Japan's lost decades is not just the crash, it's that the world never fully understood why it happened. And because of that, we risk repeating it. To understand the crash, we must first understand the illusion. After World War II, Japan experienced what economists called the economic miracle. From the 1950s through the 1980s, rapid industrialization, export dominance, technological leadership, high savings rates. By the mid-1980s, Japan was a global powerhouse. Then came the turning point, the Plaza Accord of 1985. Major economies agreed to weaken the US dollar, which caused the Japanese yen to sharply appreciate. To offset the stronger yen, the Bank of Japan lowered interest rates. Cheap credit flooded the system. And that's when the bubble began. The asset explosion. By 1989, the Nikkei stock index reached nearly 39,000. Tokyo real estate prices became surreal. Golf club memberships reportedly cost over $1 million. Land prices in central Tokyo rose nearly 300% in a few years. The belief was simple. Land prices never fall in Japan. Banks lent aggressively. Corporations borrowed to speculate. Households believed prosperity was permanent. But beneath the surface, the growth was no longer productive. It was financial. It was leveraged. And it was fragile. In late 1989, the Bank of Japan reversed course. Concerned about overheating speculation, it sharply raised interest rates. The effect was immediate. The Nikkei collapsed. By 1992, it had lost more than 60% of its value. Real estate prices followed. The bubble had burst. The domino effect. When asset prices collapsed, banks were left holding massive bad loans. Corporate balance sheets deteriorated. Consumers stopped spending. But instead of forcing bankruptcies, Japan did something unusual. It protected its institutions. Rather than allowing creative destruction, authorities supported failing banks and companies. This led to the rise of what economists later called zombie banks and zombie firms. Institutions technically alive, but economically dead. Western reaction. In the early 1990s, many Western economists dismissed Japan's crisis as cyclical. They assumed recovery would follow the normal pattern. They underestimated the structural damage. What Japan was experiencing was not a normal recession. It was something deeper. To understand Japan's stagnation, we must look beyond economics. We must examine culture, Keiretsu, and institutional loyalty. Japan's corporate structure evolved from pre-war conglomerates known as zaibatsu. Post-war, these became interconnected business groups called Keiretsu. Companies owned shares in each other. Banks supported affiliated firms. Stability was prioritized over competition. This structure had powered Japan's rise. But during the crisis, it slowed reform. Firms were not allowed to fail easily. Losses were concealed. Risk-taking declined. Social values and risk aversion. Japan's society places high value on consensus building, stability, institutional harmony, long-term employment. Admitting failure carries social stigma. Radical restructuring disrupts harmony. So instead of rapid reform, Japan moved slowly, very slowly. The result? A prolonged balance sheet recession. Economist Richard Koo later described it as a situation where companies focused on paying down debt instead of investing, even when interest rates were near zero. Monetary policy became ineffective. Western versus Japanese crisis. Philosophy. Western economies often embrace bankruptcy as discipline, aggressive restructuring, market-driven correction. Japan embraced gradualism, institutional preservation, social stability. Neither approach is inherently right or wrong, but misunderstanding the difference led to misdiagnosis. The global market believed it understood Japan. It didn't. Western economic models assumed lower interest rates equals recovery, fiscal stimulus equals growth, structural reforms equals quick rebound. But Japan's problem wasn't liquidity, it was solvency. When balance sheets are broken, cheap money does not create growth, it creates stagnation. Overconfidence of global finance. During the 1990s and early 2000s, many investors treated Japan as an anomaly, but Japan was actually a preview. The 2008 global financial crisis revealed similar patterns: asset bubbles, excess leverage, banking fragility. Yet even then, Japan's lessons were only partially absorbed. The cross-cultural blind spot. Economic analysis often ignores culture, but institutions are shaped by values. Policy effectiveness depends on social structure. Japan was not broken, it was different. And because the world failed to integrate economic theory with cultural literacy, it misunderstood the stagnation. Japan's lost decades offer critical warnings. 1. Asset bubbles are often invisible until they burst. When prices rise for years, they begin to feel permanent. Today, many regions face elevated real estate markets, high equity valuations, expanding public debt. History shows that confidence can mask fragility. 2. Demographics matter. Japan's aging population amplified stagnation, lower birth rates, shrinking workforce, rising dependency ratio. Many developed countries now face similar trends. 3. Balance sheet recessions are different. Traditional monetary tools may fail when private sector is deleveraging, confidence collapses, structural reform is politically difficult. This is highly relevant as global economies face potential slowdowns in 2026 and beyond. 4. Culture shapes recovery. Policy imported from one system may fail in another. Globalization does not eliminate national differences. Ignoring context leads to flawed prescriptions. Japan's lost decades are not simply a story of economic failure. They are a story of overconfidence, structural rigidity, cultural misunderstanding, and global misinterpretation. The real lesson is this: economic crises are never purely financial. They are institutional, they are psychological, they are cultural. As we navigate uncertain economic conditions in the coming years, Japan's experience is not distant history. It is a warning. And perhaps this time, we should listen. If you found this analysis valuable, subscribe for deeper insights into world affairs, geopolitics, and global economic shifts. Because understanding the past is the only way to navigate the future.